Hi, folks, and good afternoon or good evening, depending on where you are in the world. I'm Sam Chandan, Director of the Center for Real Estate Finance Research at NYU Stern. I'm absolutely delighted to be able to welcome you to this important reunion event with Dana Roffman, MBA class of 1994. We are going to be talking about Dana's career in the real estate industry at Angelo Gordon for just over 25 years, and now a board member at Savills globally, as well as a number of other companies, principally in the Proptech area here in the New York City region. We'll also be talking about Dana's outlook for the sector, and on occasion, from time to time, I'm going to be dropping in a few notes about some of the things that we're doing at the center. It's a really exciting time to be in real estate, and we're really delighted that you're able to join us. Dana, thank you so much for being here with me.
Sam, thank you so much for asking me to join you here, and I'm so glad to reconnect with the Stern community. So I'm happy to be here.
So, you and I have known each other for many years, and we've worked together in several different capacities, whether it be, debates about Proptech, work that we've done together on diversity, equity, and inclusion initiatives. I want to dial back to your having graduated from Duke undergrad and right away having gone into the real estate sector. Maybe just tell us a little bit about how you got your start. We do have, some students who are participating, as well as some young alumni, and I think it's going to be a real interest for them.
Sure. So I was one of those people who graduated from undergrad without a clue as to what I was going to do. So I went from pre-med to, I don't know, getting a political science and cultural anthropology degree, and all I knew was I graduated. I was originally from the New York area, and I did not want to move back to New York until I knew what I was going to do and had a job where I could pay my rent and live in the city. I wasn't moving home. So I moved to DC, where it was more affordable, and had friends to live with, and I figured it out, or I spent some time figuring it out. And after sort of my first job, which was at a nonprofit, I did some soul searching, and I came to real estate finance and investing just through friends that were in the career. I was very interested in ultimately getting into finance, even though I had only taken like accounting and finance 101 undergrad. I knew I had a lot to learn, but I just liked the fact that, what people like about real estate, that you get out of the office and interesting people and dynamic projects. And there's a lot to like about, it's exciting. So my timing wasn't great. It was the fall of 1989, the S&L crisis was in full bloom, and the RTC was about to be formed months later. So, banks are shutting down, real estate's being foreclosed on. I got a job with a boutique mortgage broker that lasted 7 months. And although it might not have been good timing for them, they had a lot of local developer clients who had these great projects and needed financing. There were no loans to be had, but that was their problem. I learned what a lease comp was, a sales comp, how to do a discounted cash flow analysis, cap rates, amortization tables. And so when they folded, I knew that this is definitely what I wanted to do, but I still wasn't ready to move back to New York. And I gave myself a short window, and thankfully I found a position at a consulting evaluation firm that became the real estate services group of Arthur Andersen, which was one of the big accounting firms at the time. They had national clients with lots of troubled properties in the currently absent market heading into a recession. I was there from 90 to 92, flew all over the country valuing industrial parks in Dallas and multifamily buildings in Portland, Oregon, and big commercial land developments out in Northern Virginia. And it really taught me how to value real estate when there were no leases and no sales. You had to go back to the fundamentals, right? You had to look at demographics. You had to look at supply and demand. And you had, when was absorption going to, when would things turn around based on trends and projecting values based on data, right? And it was interesting. And I liked it. It was great. After 2 years, I'm going back to New York, NYU Stern, getting my MBA. so I understand really what I'm doing, put it in context. And that's how, I spent 2 years at Stern, which was a great place to be. I think I was in the first class in the building on West 4th Street. That was before that, the Stern was downtown in the financial district. So the building was new then. It was great. I think they only did not have a real estate center at the time. There were maybe, I got a finance degree, and I think there were maybe 2 classes in the curriculum in the school, in the MBA program on real estate finance. And then I was allowed to take 2 classes at the master's program at Schack as part of my degree. So I did that. And, graduating in 94 was just coming out of the recession, and it was still a pretty thin job market. But through, the contacts, being in New York was key. Stern still provided me like all the, great connections to all the great firms that were sort of, working their way out. I really knew I wanted to make a move from the client service side to the principal side. And I interviewed with, one of the interviews that I got through the Career Center was with related companies at the time. Although I wasn't the right fit for the job that they were looking for, somebody unbeknownst to me forwarded my resume to Angelo Gordon, which who knew what Angelo Gordon was at the time? They were a credit and risk arbitrage shop who had decided that they were going to they had raised their first real estate fund, $30 million, they had a $50 million separate account, and they had done 5 deals with firm capital. There was no internet, so it was really hard for me to get any information on them, especially real estate wise. But I met with the people. They were great people. They were smart. It was a small shop. At the time, they managed $600 million. I didn't know if that was a lot or a little, whatever. It didn't matter. I just sort of took a chance because I said, you know what they're doing is what I want to do. They are principals investing in interesting deals, the opportunity that came out of the crisis, recapitalizing local developers, doing joint ventures, and investing in doing acquisitions and asset management. I was part of a 3-person team.
Yeah. So I want to ask you about sort of how the S&L crisis, when you were getting into the market for the first time, compares to, GFC, compares to where we are now, where, given the potential for rapidly rising interest rates, we have some headwinds of our own in real estate over the course of the next year. Before we make that comparison, though, how do you feel that entering the industry at a point of significant crisis helped or hindered your career? Would you have traded that for anything? My sense is that, from a learning perspective, what better time to be entering the industry when things aren't going in the right direction?
Right. In hindsight, I was like, that was really helpful. It's actually, I think there's so many, change and crises. They create opportunities, and already so many new different types of, investment theses and trends have come out of COVID that are different than the GFC, that are, a little bit of some parallels from the GFC to the savings and loan was, the over leverage, right? There was, and then the sort of lending spigots being cut off. There was a period of time between 2008 and mid 2009, you could not, even on a Class A office building, you couldn't get like a non-recourse loan. That it just wasn't available, and so it was different. Really, I feel like the real estate private equity business was sort of born out of the RTC era. And by the time you get to the GFC, you already have all of these mega funds and a lot of money and probably a lot of more foreign players. It becomes more of a global type of, I guess it's always been global, but different players coming in that, ultimately can help pull you out. But it's sort of just having the experience and perspective, having gone through several cycles. And there were a lot of little mini cycles in between those. In the late 90s, there was the Russian currency crisis. And then there was the dot-com bubble and the telco crisis, in the early 2000s. for us at Angelo Gordon, we found there were opportunities that came. There were great investment deals. We were for the most part initially just an opportunistic investor, and then in the 2000s we also raised parallel funds to do Core Plus, a little lower on the risk spectrum, but we were able to buy like better quality assets at lower out of distress, because sometimes core investors, depending on the balance of their portfolio or their needs, if it's a pension fund that needs to make regular distributions to their members, and all of their assets are in real estate, or a predominant amount of them, sometimes they have to sell their best asset when you can't sell anything else, and if you kind of are in it in the right place and kind of focus on your markets, you see opportunities. COVID was different because so many things happened during COVID in terms of just like changing, the way people view their work-life balance, I think. And we're not really sure where that's ending up. We're still sort of in flux, but it was already sort of trending towards, developers, at least in like the office buildings, the whole amenity floor, that was all happening before COVID, where you were really trying to create like a place that people wanted to spend time, in their office, kind of going after sort of wellness and those types of things. But I mean, so many other things have happened during the whole period with George Floyd and the whole movement to really focus on, DE&I and ESG. Like, I feel like there's so many, like during the past couple of years, we sort of came out of it. And now not only are we trying to figure out what to invest in besides, last mile, industrial, biotech, and single family rental, and multifamily, but how do we incorporate all of these other factors that are important to our investors and shareholders of public real estate companies, and also our tenants, right, to attract talent. They want to work in diverse workplaces. They want to be in a building that they know is made with sustainable, has sustainable practices employed in its operations. And there's just a lot. There's a lot that's changed, and I think that creates a lot of interesting opportunities. So.
Yeah, so, to your point about sort of being able to, if you have preferential access to capital during a downturn when no one else does, either on the debt or equity side, you can take full advantage of that. Sam Zell is coming to New York in June to sit down with the Stern real estate students, and certainly he'll be able to back you up on this idea of being able to make the most of the early 1990s if you happen to have access to cash, and building a portfolio off of that. To your point about how so much has happened in the last 2.5 years, and our public and individual consciousness around sort of what's important, what our values are, is so, I feel, radically changed or informed by so much of what has happened, the pandemic aside. But a big part of that, and you're right that it's an ongoing dialogue and exploration. We don't know what a post-pandemic world looks like for real estate. Every day firms are having to evaluate and make decisions about, test the waters on, what will the new norm look like for, office using, or how are we thinking about sort of our preferred, place to live, and balancing, access to the office with access to a good quality public school. We have a question from the audience in this regard, and folks, I am watching questions as they're coming in, so please don't feel like you need to wait till the end. But for those of us in New York City or any other major city around the world, the question for you is, do you think that New York City real estate ever fully recovers? Are there parts of the industry, certain property types that exhibit more robust recoveries than others?
I think it does recover. I mean, just look at all the companies and the young people that want to be here. I think that I actually was just saying this to I mentor through a couple of different organizations and young mentees. And I was saying how, like, the young people want to be here. They still want to come and work here. They all are, as soon as the pandemic restrictions, they're out. They're socializing. There's an energy about the city, and I think that you just look at all the companies that want to be here. I think that what we don't know yet is how will the companies really be using their space, right? I mean, people are trying to balance there are a number of major financial institutions that are making people come in 5 days a week, that's one way to go about it. There are others that are trying to work out hybrid, and trying to figure out how does that work so that you can have people still in person collaborating, because you definitely need to have that. And people are social beings and want to be together and want to work together. And that's how, the most efficient, ideas are generated, problems are solved, and how young people learn. It's very difficult to learn anything or on a screen, and when you have to type someone an email versus just popping in and asking a question. So I think that I've heard many office owners and operators say that in the new use of space, I may need more space for my company, right? Because or the tenants may need more space because because how people, whether maybe there's going to be, before the pandemic, there was a big thing about all open air shared space. Now maybe you need more private offices and still need places for people to commute, to come together. So I think the jury's still out. So far, it's obviously favored a lot of the, cities in the country that have better weather, so you can be more open air or outside, or, not in an elevator. But I think New York is coming back, and just look at the residential demand. Look at apartments, and it's impossible to find a place to live. People are here.
It is, and while NOI and net operating income is growing, valuations are high. There's liquidity for apartments. The other side of that is we continue to see an affordability crisis. In major cities around the United States, including New York. And I know that there are folks around NYU that are keenly focused on developing policy options for how it is that we can address some of those affordability challenges. To your point about sort of the value of coming into the office, I tell my own students every day as they're looking for internships and jobs, whether it's for mentorship or learning the way you contribute to the culture, the firm and the individual capacity for innovation, the value of physical co-location is what sort of ultimately will underline the office recovery. A follow-up point on this, though, and you mentioned sort of your young people wanting to go out and be in the city. When I'm looking at data on attendance at football games, basketball games, concerts, Broadway, restaurant reservations, New York is clearly back, as is most major cities around the country. But when we look at the office occupancy numbers, that's lagging sort of all of that leisure and hospitality. Is that because we're still just figuring out the office piece, or that in terms of the actual number of days, to put it in sort of very blunt terms, we're still just figuring out what sort of for my particular company makes sense?
Right. I think that's the case. And with hospitality, you still have, look at Asia, you have these rolling waves of COVID where people are not traveling. And there are a lot of, it's so funny, you're not as aware of it when most of your life and world revolves around New York and the US. But my, involvement in being on the Savills board, which is a London public company, they do have, they do operate in North America, but they're much larger in Europe and Asia. And it just makes you more aware of, how the pandemic sort of rolled across the world and how different countries handled it differently, and how they keep, how people, we haven't had like we still haven't had an in-person board meeting where we have two board members, one in Hong Kong and one in Singapore, where they were able to attend. So, it's just, you don't realize that you feel like things are better here. I remember whenever it was, several months ago, speaking to someone in Toronto and how far they were behind. And you just forget that not everybody's living your same reality. So I think that there's like a lag factor there. And I have heard more and more each week, oh, so-and-so started traveling again, like people that weren't traveling for business, whether it's a lawyer or bankers, people are traveling again. People are, and you can see it in the airlines, right? I mean, it's I just think it takes time for the engine to get going, right?
Yeah. So speaking of folks going to places where the weather's better, you and I have a long list of common friends who at least for part of the pandemic, headed down to Florida. Some came back, some did not.
Right.
What is your sense of what is the lens that you would put on, that this notion or idea that, we've got a mass exodus from the Northeast and Midwest in favor of the Sun Belt? Quite frankly, the data doesn't support the idea of a mass exodus, but in terms of the relative competitive advantages, has the pandemic shifted things in a way that New York is just going to have to work harder to compete with other parts of the country?
I mean, I definitely think it's looking at Miami and the development going on down there and the demand and, the affordability crisis there. I mean, rents have gone up tremendously. And, demand for sure. I think, I think that it's basically just another layer that, we're going to have to figure it out. We definitely have to do something to make New York more competitive, right? But New York and the Northeast has a lot to offer that these other areas do not. And, I don't know. I just think it's going to take time, and your colleagues who are working on, policy solutions and probably a lot of public-private partnerships to maybe, turn things around and, solve some of these issues.
Yeah. And absolutely. I mean, if you're for someone doing real estate or studying real estate, the agglomeration value being New York City, there's nowhere else. Certainly from my vantage point, there's nowhere else in the world, that you want to call home base. There is a follow-up question on sort of this issue around some of the headwinds that we may face over the course of the next couple of years, and I think it's foremost on a lot of people's minds. Whereas we're not necessarily characterized by over leverage in real estate this time around, we're not talking about sort of an inherent level of instability in the financial system. We have generationally high levels of inflationary pressures, and a pretty robust debate around how long-lived those pressures will be. So the question that's come in from the audience, and folks, again, delighted with the questions coming in, is as we see a higher inflation environment, at least for the foreseeable future, what does that mean for your thinking about real estate as an asset class, and whether or not there may be some sectors that are preferred investments that will sort of do better in a high inflation environment than others?
Right. I mean, well, there's always the people look at things like hospitality where you reset your rate on a daily basis, or multifamily on a monthly basis. You're obviously able to sort of sometimes capture some of that, capture it on the revenue side as your expenses are getting, more increased versus, office buildings or properties or even industrial where you have much longer term leases. I mean, industrial, most of the inflationary costs are generally passed on to the tenant, because if you're in a triple net, situation, but I don't know. It's interesting. Same thing with, if you're looking at, rising interest rates, right? That will affect some that are investing on a more short-term basis and need to exit on, possibly at a time where you might not be able to get as much, your buyer may not be able to get as much leverage if they need it, versus longer-term holders or generational holders that never sell and use low leverage, and maybe it's not even a factor. So I definitely think there will be bumps in the road, and people are going to look to cut their expenses in other ways and operate more efficiently, which leads into sort of the Proptech sector, where it's kind of my segue, because I do think that is something that I became towards the end of my tenure at Angelo Gordon and sort of in the mid 2015s, I sort of, it sort of was kind of gaining a lot more publicity in terms of technology solutions that were geared towards whether it was, our investment management business and helping us, coordinate between the acquisitions team, the asset management team, and the marketing team and the accounting team without like manually inputting data into an Excel spreadsheet, right? But I mean, a lot of that did happen where you had multiple versions of the same data in different systems that didn't speak to each other. And it has been a big problem for a long time with a lot of companies. And then just in terms of like operationally, monitoring your building systems on site, and then, all different other kinds of technology that, make life easier for your tenants in terms of, ordering food or booking a conference room or letting somebody into the building. And so all of these things definitely help you operate more efficiently and cut your costs. So as the real estate industry starts to adopt more and more of these technologies, I think that will also counterbalance some of the, other pressures that you have from, volatile, oil prices and inflation in general. And it's just an interesting, exciting time. So much has happened. And so that was something that I was personally interested in. And through some colleagues that I met through the NYU Schack board, I sort of joined a team and people that and are involved with, who was looking at these startup deals where really smart founders were creating interesting technology for the real estate industry, but they had no real estate background or knowledge or network. And so that sort of helped me when I was leaving Angelo Gordon, kind of satisfied my deal junkiness, looking at and meeting with these founders and, backing some of them and advising some. And that's been really exciting. And I just, I think it's exciting in a lot of different ways. And also with like climate technology, which is like obviously a big focus now these days because all of the spotlight is on real estate as a huge contributor to greenhouse gases and how to.
Sure, yeah. And here in New York, Local Law 97 just being one example of a local initiative that really is, forcing people's hands, whether, they're addressing climate issues is important for you as an individual or for your firm. The city's mandating that we're going to reduce the carbon footprint of the real estate industry. Folks, we have so many amazing questions coming in that I feel like I might have to move to a lightning round. I'm going to sort of try and structure these in a way that follows some coherent path. One of the questions that's come in, people are asking about what are some of the ways in which I as an individual may be able to participate in this really exciting period of change that's being motivated by the introduction of new technology platforms to the real estate industry. And maybe if you could even opine a little bit on, what are SPACs and what role do they play, or what role have they played thus far in real estate?
Well, the SPAC is really just, it's basically for everyone who's on the call very simplistically, it is technically a blank check company. What that means is you raise the funds for the company, and when it goes public, it is basically a public pot of money with sponsors. In the case of SILVERspac, the board that I'm on, it's sponsored by the chairman and CEO of Silvertech Ventures and a board that has expertise in a particular area, and then it has a time period when it needs to go out and complete some sort of business combination, whether, which generally if you combine with a private company, combining with the SPAC, essentially it's like a different way to take it public. And this SILVERspac, the SPAC that I am on the board of, is seeking to combine with a business that provides technology and innovation solutions to the real estate and financial services industries. So really, it's just another way for some of these companies that are in a later growth stage to go public versus an IPO. So in terms of taking part in or learning about, there's just so much news and information out there. Even I feel like in just sort of the traditional real estate, all the news that I would normally read through, like the Commercial Observer or BizNow or CreTech is one, which solely is a news source that has a news feed that rounds up all the latest news on every Proptech startup or funding. They focus in the US and as well in Europe. So there's a lot of ways that you can sort of try to, learn about them and find out about them. And then, in terms of using their technology, I'm assuming that you can reach out to the companies that have technology that you're interested in. I'm not exactly sure what the source of the question was.
Sure. Well, I again, sort of just a plug for some of the exciting things we're doing at the program. I definitely want alumni to know that we're continuing to innovate and do exciting things with the curriculum and prepare students for a rapidly changing industry. This fall, one of the new courses that we'll be offering for the first time, and we hope it's very much core to the real estate curriculum, is a course focused on real estate data science and artificial intelligence, really sort of supporting students and preparing them to be able to leverage data that so many organizations have in far greater abundance than has been the case historically. I'll also go so far as to say that if you're in the fintech space, there's really no better place to be in academia than at Stern, and we're hoping to leverage some of that into the work that we're doing in Proptech and have some exciting things on the horizon. So alumni, please feel confident that we're investing heavily in making sure that our curriculum is supporting students in entering sort of this industry that, as Dana's described, is sort of at a very exciting point, but one that's changing very rapidly. Dana, if I can switch gears for 1 second, one of the areas that you and I have focused on together has been creating opportunities for emerging women leaders in the real estate industry, whether it's in building networks, helping folks to connect with more senior, more established folks in the industry. One of our alumna who's in the shopping center space is sort of describing a scenario where, like many other parts of our industry, it's very male dominated, and asking sort of, as compared to 10, 15, 20 years ago in the industry, how things changed, and what advice do you have for a woman that maybe, for example, entering a relatively smaller development firm where they might be, there may not be sort of another woman mentor or champion for them?
Right. Yeah, no, it's interesting. I've been asked the fact that, when I started out, all the partners, pretty much every single local development operating partner that I work with, none of them were female. There were no women. I didn't really think about it. We did have women in our group. In the 2000s, I actually, the vice president director who worked with me on covering the Mid-Atlantic and Boston was a woman, and I loved it because if somebody wanted to do a deal with Angelo Gordon in those markets, they had to deal with two women. It was great. And we developed, I'm still in touch with and close with all the developers that we, funded and partnered with. And I think, there can't be enough said about diverse teams and how it just improves your performance. It's proven, there've been studies about it. And it's actually really interesting because I was, having this type of role. It's really 24/7. If you're doing, acquisitions, they don't stop, deals don't stop. And asset management, you're always sort of half on the phone, not really present. And I actually do have a family, and I had young kids in the 2000s. And, in 2010, I switched, and it was traveling a lot, and I switched to covering New York. And that was the first time, once I was really not traveling as much, that I felt, and my kids were older, I took the time out to actually start getting involved in, boards like NYU Schack, a great organization, WX, in New York, which is several hundred women in New York, senior women in New York real estate who, not just, investment professionals, but lawyers and accountants and brokers and architects. And it's just a great organization. And through that, I've actually I'm on the mentoring committee and had mentees that are going through programs like either their MBA or or getting their master's degree at Schack or others, or Stern, or other schools. So that has been great. There are a lot more. I think it's very, very important. If you don't have somebody that you can talk to, that about all the things that you're going through on your team, it's really important to try to reach out and try to find somebody to have that kind of relationship with. I happen to know one of the former junior colleagues at Angela Gordon is this fantastic woman on the West Coast who's created a network of over 100 women in real estate investment across the country that are in their 20s, right, to create their own network. And they invite senior women to come speak with them. And there are a couple of other groups I know of in New York where there are meetups. So I would definitely just try to, ask around, see if there are people that that are familiar with any of those types of groups, or try to reach out to somebody that you interact with that isn't directly at your firm. Maybe it's a broker or a lawyer, or somebody that, you can ask to maybe introduce you to someone that would be interested in that. But that's actually something that I'm personally very interested in developing, because I do think not just women, but, minorities who are very underrepresented in real estate. And there are a lot of initiatives to try to improve minority representation in all aspects of real estate as well. But the one thing that's missing really is the network, right? I mean, that's what really helps you in terms of opportunities and knowing about jobs and even deal flow, or having time to go out to networking events that are thrown by brokers or whatever, that'll go on, or, even at NYU or your class or whatever it is, or conferences through BizNow or whoever that puts them on. So I don't know. I think that's something that's really lacking and needs to be developed, like ways for people to have just quick chats to ask people questions, something I'm thinking about.
So let's say, the one other side plot. So June 28th, folks, where the center is going to be hosting, its first major women's leadership event. And if you are interested in getting involved, it really is going to be focused on some of the things that Dana described, helping to build those more informal relationships, those networks, particularly focused on Stern women in real estate. So I hope if it's of interest for anyone, make sure you reach out. I can't tell you, folks, this is honestly such an exciting time to be active and engaged with the real estate program here at Stern. So, please don't be shy at all. Dana, there's so many more questions. One of the questions that's coming up, also during June, we're having our first ever Pride event. It's Pride Month here in New York, and we'll be doing an event for LGBTQ students and professionals in the real estate industry. So if it's of interest for anyone, again, please don't hold back. This is such a fascinating question, Dana, that I've also wondered about. Someone's recalling TRIA. So folks, if you're unfamiliar with this, after 9/11, the Terrorism Risk Insurance Act became critical for our being able to provide financing for significant assets in markets like New York, Washington, D.C. This is, again, terrorism insurance. The government became actively involved in ensuring we had access to it as an industry. So one of our alums is asking, is there potentially a market? Do we need a market for something like pandemic insurance, where, like terrorism, you're really unclear from an actuarial perspective what the frequency or severity of future events might actually be?
Yeah, it's interesting. I actually read an article recently through a friend of mine who has done some defending of retailers and retail litigation that she penned about the fact that a lot of retail tenants, this is analogous, and landlords are negotiating pandemic type clauses into their into their leases because they have the same problem in terms of continuous operation. And, the debate between whether, a tenant can or should or has to pay rent during a pandemic and what is force majeure and what's a force majeure event. So I think a lot of these types of questions are being kind of debated and probably litigated right now. That's just, one anecdote of something that I read of somebody who's actually, working on this actively. I'm not really sure about insurance, but I would think yes. I mean, there are certain aspects of, right, there's some pandemic related insurance related to travel where you can insure, right, your airfare or whatever it is. So I'm assuming that for a price, perhaps.
That makes sense, because even if it's not the next pandemic, we know that in an endemic COVID scenario, from time to time, we might reasonably expect to experience surges, and there may be local responses in terms of limitations on our behaviors, our ability to socialize, whether we have to wear masks in restaurants or on subway systems. And so even if it's not insurance, in the private market and that contracting between tenant and landlord, some acknowledgement or flexibility around that uncertainty that it must introduce to our ability to fundamentally operate spaces. Here's a question that might bring together a lot of this stuff. Someone is saying, asking that they have $1 million of capital to invest. And so here's sort of a real synthesis, of a lot of the different things that we've hit on. But whether it's 100,000, a million, or 10 million, I don't know if it changes the answer. But what are your thoughts on how to deploy it?
Oh man, that's not fair.
No, it's not.
I need to know more about you. Do you what's your risk tolerance? Are you looking, that's the same thing. Like so many different people have, you have the same $1 million, $10 million, $100 million to invest. And do you require a return immediately on that? Do you need a monthly return? Do you want current cash flow? Do you want your return to be back-ended? Can you tolerate sort of a repositioning risk where you may be, taking some, investing $500,000 and using the other half to sort of upgrade and reposition your asset to have something that may be more valuable at the end of the day, but you're taking timing, execution, cost risk. I can't really answer that. It really depends on so many different factors when it depends on what type of investor you are. So many people would take that same money and do many different things depending on what their personal needs, wants, and expectations are.
Absolutely. I mean, I have to agree completely. The right answer is it depends. And one of the things that matters a lot is the first thing you mentioned. I mean, depending on your individual risk tolerance, and whether that $1 million that you have to invest is 1 million out of a larger pool of 100 that you have diversified across a much larger set of asset classes, or whether that million is what you have to work with. A lot of things are going to make a big difference. And this dovetails with the next question. Part of what will drive the answer is also, what is your investment time horizon? Is this sort of a buy and hold investment, or is this capital and an investment that you want to harvest over a relatively short period of time? So Dana, another one of our alums who's based in Memphis, is saying that in the multifamily sector there, and I don't think this question is Memphis specific. Okay. Thank goodness for both of us, but right now, what they're accounting is an anecdote where in their particular market, they're seeing a larger number of relatively short-term investors that are looking for yield. Is that something that you feel is characteristic of the market? Are we seeing sort of systematic changes where we have a larger number of relatively short-term investors? Does that change in an environment where the required return on investments rises along with the broader interest rate environment? What are your thoughts on that?
No, I don't know. I mean, I think institutionally you're seeing a lot more emphasis. if you're looking at like the on raising funds to invest in longer term investments, right? Or making bigger, longer term bets. That seems to me to be like more of the trend versus the short term quick flip. But if you're looking at, it depends on the size of, if this is sort of an institutional type, or we're just talking about like smaller rental properties. People are coming in and seeing that, in these growth markets in the Sun Belt, they're seeing a lot of population influx and demand. And I definitely think that they could be arguably late to the party, because I'm sure there has already been significant appreciation, pre-COVID, post-COVID, from just the supply demand, the demand influx that could not support the supply. So it could be that some of these short-term flippers are going to get burned with rising interest rates, which may, hinder their returns on the back end in terms of, depending on how long, it lasts in terms of, you really have to look at the yield curve and factor that into what type of return do you think you're, on the exit, your buyer is going to require, and what his mortgage is going to cost, because that's going to eat into that. If you're going to be selling to somebody who's not using leverage, then it doesn't matter as much. And if you think that the supply demand imbalance still exists and rents will continue to go up, then it's probably a good idea. Just sort of depends also how much new construction there is. Like, has everyone gone in? It's one thing to buy existing product, but if there's lots of ample, redevelopment or new development land available to compete, then your quick flip, may not be as attractive. It just depends on timing and sort of.
There's so many factors, right? I think at a very high level, folks, in an environment of higher rates, or imagine sort of a scenario where there are two things driving appreciation. One is improvements in property income, and the other is the capital markets. In an environment where capital is more expensive, both debt and equity, you're going to become more reliant on improvements in the underlying fundamental performance of the property to drive appreciation, and that will tend to lend itself to longer hold cycles. Dana, you mentioned sort of supply. Interested in your perspective on this. One of the clear constraints on new development activity over the course of the last cycle has been rapidly rising costs of construction labor, limited supply, but also in the materials space, whether it be softwood lumber, concrete, steel,
and time delays.
Land, yeah.
No, delays, like delivery delays, right? Supply chain issues. There's so many other things besides, part of it is they're all related, right? It's harder to get your supplies. There's supply shortages. It takes longer to get there. So time obviously adds to your budget. It's making new development. You'd think this is, real estate always lags, right? It takes time for the engine to catch up to what's actually happening in real time. And there are projects that are already sort of, in process. And sometimes people decide it's better to just complete the project, even though it's going to take longer and cost more, than stop the project. But yeah, there's been a lot of pressure on costs, and that'll have a factor in sort of probably halting new deliveries in terms of new starts, not deliveries, but starts. So that will, hopefully at some point bring things back into, you'll have a large influx of everyone who's trying to get ahead of the curve, and then it'll get absorbed, and then there won't be supply for a little while because there'll be a lag. It just depends, They're all of these and all of these dynamics are different in every micro submarket. So you really have to know the market. So like for your $1 million, wherever you're investing it, don't go to like someplace you're not familiar with and buy a property. Invest in what you know. And if you don't really know anything, give it to somebody who does and pay them a little bit of a fee, because it's worth it. It's just, if you know your neighborhood and you know the dynamics of it and you're comfortable, renting or operating, whatever it is, then that's great. But otherwise, there are plenty of qualified people out there that will help you take your money and charge you a little bit of a fee, but I would think, be better off. potentially.
Yeah, no substitute for knowing the market. I was thrilled to hear that, in addition to so many, long-standing and well-established alums of Stern's programs, that we have a lot of, younger and more recent alums as well. My last question for you, Dana, before we wrap up, is really, coming from that crew. I have to say, I mean, you do spend so much time and make yourself so available for mentoring of students at NYU, which has been a great blessing for us. For an early career professional or a current student in the program, what's your advice?
My advice is, I think it's a really exciting, dynamic industry. No matter what is currently going on in the environment, there's going to be opportunities. Figure out what it is that you like to do. There's so many different roles that you can play in this industry. You can be an investor, you can be a lender, you can be a broker, you can manage a property, you can, develop a property, you can be the architect of the property, you can collect the data to drive the decisions and create the strategy for the investment. So, a lot of it has to do with whether you like to be, are you a relationship type person? Are you more of somebody who likes to work on a computer and work with numbers? Just figure out, where, if you're excited about the industry, where your personal strengths will be best suited, and always make sure you're working with good people. So, you spend most of your time at work, and, you need to be happy. And there's plenty of places out there that have, great people in this industry. So those are the things I would think about.
Dana, it is always a joy to see you, and thank you for everything that you do for NYU. I can't tell you how much I appreciate it.
Thank you so much for having me. This was really fun. And take care, everyone. Enjoy your reunion. Bye-bye.
Folks, as I mentioned, so I've been at Stern now for about 2.5 months. We've got some really exciting stuff happening at the Real Estate Center, and if you're interested in hearing more about it, please don't be shy. Please don't hesitate. Give me a buzz. I'm really excited about the opportunity to meet more of our alums over the coming months. And so, again, thank you, Dana. Thank you, everyone, for attending. Thank you for the team at Stern and the Alumni Relations Office for organizing this program and Stern Reunion Week. We'll look forward to seeing you soon.